Well, there will be 2 recordings, obviously, for this session. Okay, I started again the recording. Okay, so now, as you can see here in this statement, we converted from the numbers into the common size financial statements by using the ratios, which means we converted numbers into percentages, and now we can see how the percentage goes. From the high percentage, first year, second year is low, then start going again. Is the company is going to continue on the rising curve? We don't know. We have to see one more year. Based on the first 2 years, we might expect after 22 to be down as well. But that's just expectations. Now, we can use, for the ratio analysis, we can use to compare the results from one period with the next period, or compare one company with another company. We also can use to compare company in different size more easily once we're using this common size financial statements. Which are the common ratio categories that we're gonna use to compare companies? The most common categories are liquidity ratio, ratio related to liquidity, activity ratio, solvency ratio, profitability ratio, and equity analysis ratio. Now we're going to go one after another to see what's the difference. Liquidity ratio. Those are related to ability of the company to convert assets into cash for only and only one reason, to pay the liability. This is important part of the liquidity analysis when we consider the ability of the company to pay the short liability with the short-term assets. There are 2 commonly used ratio here. We're going to have current ratio and you're going to have quick ratio. You're going to be tested on those ratios. So you better understand that the most common used liquidity ratios are current ratio and the quick ratio. What they measure ability of the company to pay short-term liability with the short-term assets. First ratio, current ratio, it will be current assets divided by current liability. So the current ratio has to trigger you to the point to get the current assets and current liability. Quick ratio, what's the difference now with the current ratio and quick ratio? In the quick ratio, we're gonna eliminate assets which are not so easily converted to cash. They're still current assets, but not so easily converted to cash. Those 2 assets are inventory, because remember, first you have to sell the inventory and then to collect the accounts receivables. And prepaid expenses. Why prepaid expenses? Yes, because the prepaid expenses is asset, but most likely we're never going to ask the money back for those prepaid expenses. For that reason, inventory prepaid expenses are eliminated when we're calculating the quick ratio. And we're dealing only with the most liquid assets. So for this company, once we get the numbers, we're going to find out that the current ratio from 162 goes to 163 and then moving to 184. First, let's think about it. Is it good for us if the current ratio is equal to 1? If the current ratio is equal to 1 means the amount of the current assets is equal to the amount of current liability. So we have exact the same amounts for current assets and current liability. So 1 is a good number, but it's not the best number. Good number because shows us that we have exactly the same assets like liability. So we can pay our liability. But the thing is, once we pay our liability, we know. Can you guys hear me? Hello?
Yes, sir.
I believe I disappeared again.
Yes.
Sorry about that. Today, the internet here is a nightmare. I hope that's not going to continue. Start again. Where did I lost you? Which part I lost you?
Current ratio is equal to 1.
Okay, current ratio is equal to 1. What that means? That means that the current assets is equal to the current liability. We have the same amount current assets and the same amount current liability. Is that good for us? It's okay. Is it the best? Probably not. Why? Because once we pay the current liability, there will be nothing left. For that reason, anything above 1 is preferable. Higher than 1 you are, better for you. Same thing is valid for the quick ratio. Having this in mind, tell me how this company is doing. Did they improving on the current ratio or getting worse?
Improving.
Improving. Definitely improving. Why? Because the current ratio start growing up. Their current assets start increasing. Even though, as you can see, the current liability increasing too. How about the quick ratios? Quick ratio, if it falls a little bit below 1, that's still okay. That's still okay. So in this case, is the company on the good trajectory or they're on a losing curve?
They look like they are improving.
That's That is correct. Looks like they're improving. Why? Because initially there was 0.72. And then on that year, they went down to 0.70. And the third year, they jumped to 0.70. Yes, they definitely improved. Let's see what the next ratio. Activity ratios. That's the whole new section. Now, this section is going to provide information about how effectively company manage the operations. Which operations? How fast they collecting accounts receivables? How fast they selling the inventory? How fast they paying their accounts payables? Which is the ratio that's going to measure those activities? Accounts receivable turnover, inventory turnover, and accounts payable turnover. So let's see the numbers here. Accounts receivable turnover. How are we going to calculating this? Credit sales divided by average accounts receivables. Why credit sales? Because we don't care about the cash sales. Cash sales we already collected. There's nothing there. Once we sell and collect it, there's nothing for us to collect. So there's no accounts receivables. For that reason, we're chasing only the sales on credit, which has to be divided by the average amount of the accounts receivables. How are we going to get the average amount? Beginning balance of the beginning of the year, ending balance at the end of the year, divided by 2. Once we're calculating accounts receivable turnover, that will be a number. Now let's think about it. Where we want our number to be, high or low? What do you think?
What number, sir?
Accounts receivable turnover. Do you want it high? Do we prefer to see high number or we prefer to see low number?
Prefer to see low number.
If we see low number, let's think about it. If we see low number here, let's say if we see number 1, for example, let's see what will be the average collection period, because that's the next ratio. Accounts receivable turnover will be used as a denominator. Let's say if the accounts receivable turnover is 1, that means the average collection period is how many days?
365.
365. Is it good for you
Mm,
to collect your accounts receivables in 365 days?
No.
No. So where do you want this number then?
higher.
Higher.
Higher. Higher number is better for us. Make sense?
Yes, sir.
So we want high accounts receivable turnover. That's going to reduce the days of average collection period. High number is going to give us less days our accounts receivable sitting in the hands of our customers. Sometimes necessary to assume that all sales are credit sales. And we can compare the credit terms for that ratio. Let's see how this company is dealing with. They're going with the high number and moving down to the low number. Are they improving the ratio or worsen it?
Worsen it.
They worsen it. What we should expect as a number of days collection? Going up or going down?
Going up.
It
Going
should
up.
up.
Should be going down.
Going up. Going up. Let's see if that's how that's gonna be. So you see, when we have a high number 12, our days in accounts receivable collection is 29. That means in 29 days we collecting our sales. When the numbers goes down to 11, that means to us it takes us 33.2 days to collect our sales. Which one is better for us? 29 days or
29 days.
29 days?
Yeah.
Make sense? So
Yes.
once you see the accounts receivable turnover numbers start going down, that automatically means that you're having problem with collection. That means your days to collect money getting higher. Higher days in collection, it's not good for you. Let's see how we're gonna deal with that inventory. Inventory, that means how many times we're selling our inventory. Inventory turnover is equal to the cost of goods sold divided by average inventory. Average inventory, again, we're going to get a beginning balance plus the ending balance divided by 2. Then once we get the inventory turnover, we're going to get how many days we need to sell our inventory. Inventory turnover is going to become a denominator. 365 days of the year is going to be our nominator. Again, that ratio tells us how fast we're selling our inventory. Question for you. Again, where do you want this inventory turnover number? High or low?
Low.
So let's see. If it's low number, let's say if the number is 2, and that comes here as a denominator, how many days takes me to sell my inventory? 183 days. Correct? Is that good for me?
No.
No. So where do I want this number? High
High.
or low?
Hi.
High. Now that will also depend on the industry, correct? On which industry you are. Imagine you are in the industry of making birthday cakes. Where do you want the inventory turnover? High or low?
Hi.
High. Why? Because if you don't sell it, you have to throw it in the garbage. Now imagine you're in the flower business, selling flowers. If you want it in the bakery business high, in the flower business you want it super high. How about if you're a car dealership?
Still hi.
Still high, but not the same as a flower business, correct?
Correct.
Unless you're selling 10 cars per day. So let's see how this company is doing. So the inventory turnover from 7.3 went down to 4.9. Is this good for a company or bad for the company?
Not.
What do you say?
Bad.
Bad. How other way we can see that is bad for the company? How can we analyze it? Now, what drives our inventory? What would drive this number? Obviously, cost of goods sold, but cost of goods sold is our denominator, right? If the cost of goods sold goes up, the inventory turnover is going to go up, correct? The average inventory, however, is the opposite. If the average inventory starts to going up, the turnover is going to start going down. What that means, average inventory? That means we're not selling our products and we're building our inventory. Higher inventory you have, lower inventory turnover you're going to have. Make sense? So you want your inventory to start going down. That means you're not holding your inventory, you're selling it. What's happened with this company? Look at the inventory in the 2019 beginning balance, 1,234. Look at the ending balance of 2021, 2,294. The inventory increased with $1,000. Well, no wonder why the inventory turnover went down. Because the inventory that they're holding in their warehouse increased. So let's see how this is gonna transfer into the day of sales inventory. In the 2019, we were able to sell our inventory in 50 days, sorry. In 2021, it took us almost 25 more days compared to 2019. So pretty much we're losing 1 month. 25 days, that's 25 working days if you put it that direction, but it's 365, so we cannot see it that way, but 25 days is almost 1 month. So that should be a good indicator to tell you that this ratio with combination with the accounts receivables, as you can see, the accounts receivable collection goes up, inventory turnover goes up or goes down, days of inventory sales goes up. That should be interesting indicator what we should expect in terms of cash collection. Correct? Now let's see what's the accounts payable turnover. Well, pretty much the same idea as accounts receivable turnover, but on the payable side. So we're gonna get the purchases that we make on credit or the purchases that we don't pay. Then we're gonna have the average accounts payables. Again, the average operating accounts payable will be beginning minus the ending divided by 2. Accounts payable payment period will be again 365 divided by accounts payable turnover. That's gonna give us information how fast we pay our purchases on credit. So let's see how this company doing. Their number decreasing. Is that good for the company or bad for the company?
Good.
Bad for the company.
Think about it. What's happening here? If the ratio goes down, accounts payable payment period goes up, correct? Because the accounts payable turnover working as a denominator. If that numbers goes down, this number is going to go up. Correct? Make sense?
Yes.
Okay. So as you can see, the credit purchases are almost kind of the 2019 and 2021, that's almost the same. But the balances on accounts payable increase,
So it's bad for the company.
right? So now before we say it's bad, let's think about something else. Obviously, our days accounts payable payment period, now in days, that's going to increase in days. From 41 days, we can now be paying 56 days. Now, having in mind that accounts receivable collection period increasing, we have to match it somehow with accounts payable. Make sense? We have to look at those three ratios in correlation. Because if we see the accounts receivable, let's say, where is that? If we see the average collection period going up, if we see that the count day to sell our inventory goes up, naturally we should have to see that accounts payables also goes up. Because if the accounts payable start going down, we may run out of cash. Make sense? If we start paying faster to our clients, but we collecting slowly, our collection increasing, and we having problems selling our inventory, how did we get the cash to pay our accounts payables? Right? That means we're running out of the operating cash. So for that reason, once we see all those three ratios together, all the three ratios going in the same curve, yes, accounts payable, that will be bad reputation for our company to the creditors, but at the same time, we are in the same direction with the processes that's happening in our company. Now, in order to reduce the days of accounts payables, first, what we have to do, we have to reduce the days of the inventory. So then we have to focus on the accounts receivable collection to reduce those days. And then we naturally, our accounts payable is going to start going down in number of days. Make sense? I want you to start looking from the ratio to draw the big picture. Don't look at the ratio by itself isolated. Link it to other ratios in order to make a connection. Make sense?
Yeah.
So the other thing that I want you to see is look at this. Accounts payable period start to going up. Accounts receivables collection start going up. We're slowing down our collection. What is the current ratio? Actually, current ratio is improving. But look at the quick ratio. Quick ratio stays the same. What's in the quick ratio? Inventory. What's happened with our inventory? Our inventory increasing. You see, from 1,681 moved to 2,294. Now, can we see that thing in the inventory? Yes, we can. We should be able to see it in our inventory here. Make sense? So once you see the ratio all together, when you combine the accounts payable, accounts receivable, inventory turnover, check the current ratio and see how this affects the current ratio. Obviously, the company, in terms of the activities, starts slowing down. But on the liquid, that doesn't affect too much the liquidity of the company. In fact, the fact that we have more inventory help us to show the high current ratio. However, that comes to the point that when you see a company with the high current ratio, it doesn't mean that the company operating well, as you can see from this example. Current ratio goes up, but accounts receivables turnover going up. Going down. And the days in collection goes up. Accounts payables go down. Days in payables goes up. Inventory turnover goes down. Inventory days to sell inventory start to going up. Let's see now the solvency. What will be the solvency here? Solvency is ability of the company to pay its obligation in the long term. So what we're going to chase here? We're going to chase the leverage ratio and coverage ratio. What's the leverage ratio? Debt versus equity. Debt to equity. One thing I want you to remember. Debt to equity, debt plus equity always have to be equal to the assets. So what that means is the assets are 100% or 1. Debt to equity ratio altogether should be equal to 100%, right? Debt plus equity should be equal to 100%. So the debt to equity is going to tell you what's the actually how you finance your capital, most heavy on debt or heavy on the equity. And then you're going to get net debt as a percentage of the total capitalization. Total capitalization will be your assets and interest coverage. Let's just check those ratios. Debt to equity will be the net debt versus the shareholders' equity. That will be the measure amount of the debt relative to the shareholders' equity. And the net debt as a percentage of total capitalization, which will be equal to the net debt plus the shareholders plus the net debt. Shareholders' equity plus the net debt, that's equal to the assets. So that will be measured the total portion of financing presented by debt. So let's see how this company doing. debt to equity ratio from 42%, 0.42, goes to 59. Is that good for a company? Obviously, the amount of debt going up. Is that good for the company?
No.
Now, before we make the conclusion and say yes or no, we need a little bit more information. Let's see the leverage ratio. Leverage ratio will be what's the portion of the debt versus the equity, versus the total assets. So as we can see here is we have 30% debt in the beginning, and now we're 37% of that. Right. So obviously our debt goes up. No questions about it. Now the question is how this affects us. In order to see that, we have to check one more ratio, which is the interest coverage ratio. Always remember this. I want you to remember this. If you get everything from this course, this is the one thing that I want you to remember. Once you see debt to equity ratio, always check interest coverage ratio. What that means is what this ratio measures. Measures the company ability to pay the interest expenses with the earnings. So this is the ratio that is going to give you a comfort if you have to lend money to the company. How many times the company can pay the interest with the current earnings? Make sense? So let's see this company, how they pay. The earning before interest, taxes, depreciation, and amortization is 1,221. The interest expense only is $8,900, or $89 in this case. Is it in 1,000 and 100? It doesn't matter. However, we can see that with our earnings, we can pay 13.6 times our interest expense. That's in 2019. In 2020, even though we increase our debt, now we can, with our earnings, we can pay 15.7 times our interest expense. Are we in the good shape?
Yes.
Yes. What that means to us, that means that even though we increase our debt with 7%, we have no problems to pay our interest expense. In fact, we can pay our interest expense 2 times more than 2019 when we were with 7% less debt. How we can interpret this number? We can only interpret it by this. Since the increase of the debt doesn't affect the interest coverage. In fact, interest coverage ratio get better. That means 2 things. Either the debt is cheap. It's cheaper for us to borrow money than it was before. The other way we can interpret it is our operations generating higher percentage return than what we pay for the interest expense. In other terms, think about it. If you have a business that generate 10%. 10% income. But you're paying 2% for the interest expenses. Do you have to worry about increasing the debt?
No.
No. Why? Because you can easily pay your debt. You're generating 10%. Your expenses, the cost of the interest expense is only 2%. You're generating 8% income. Now, if you're still paying the 2% interest, but you improve your operations and you improve your effectiveness, and suddenly your net income jump from 10% to 15%, I don't have problem even to borrow more money. Why? Because it's cheap for me to borrow money. I'm paying only 2%. Make sense? Always link it.
Makes sense.
Oh, yes, always linked. I want you to remember this. Always linked the debt ratio with the interest coverage ratio. And look those two together. If you see that debt goes up and the interest coverage goes up, you're in a good situation. But if you see that goes up and then the interest ratio coverage start to going down, then you have to stop borrowing the money, and maybe you can check a little bit more how much they pay for the interest on the borrowing first. Second, what's happened with the company? Maybe their income start getting less efficient of how they operate. That may be a signal that the company, if they continue in the same terms, it might have a problem with the way it's going to hit them on the liquidity, of course. Let's see now profitability ratio. Profitability ratio is used to assess the company overall performance. That will include the gross margin. We always have a gross margin. Sales minus cost of goods sold. We're getting that gross margin. The gross margin tells you how much you're generating for the main operation, main activity in the company. After that, you're getting that profit margin. Profit margin is after you deduct the operating expenses. From the main activity of the company, I'm generating my gross margin. After that, I have to cover all the expenses to run my business. Make sense?
So,
Expenses for the main operations are related only and only for the activity that generate that revenue. Operating expenses are related to the business itself. And then you're going to get this return of equity, which will measure how much is your return for the shareholders, and return on assets, which will then measure the profitability of the money that you invested in the company assets. Let's go with the gross margin. Gross margin is easy. Gross margin is the sales minus the cost of goods sold. You get the numbers, then you get that number divided by the total sales. It's going to give you the gross margin ratio. Profit margin will be gross margin minus the operating expenses. It's going to give you the net income. Get that net income divided by the total sales again. It's going to give you profit margin. How we can interpret that numbers? Again, how we can interpret that numbers? The first number is, again, for every dollar of sales, how much I'm generating after cover only the cost that this sells, what I'm selling. Let's say you buy computer, you sell computer. You want to see gross margin of that sales. That's going to tell you for every dollar sales, how much is transferred to the gross margin. Second, I think I lost you again, didn't I? Where did I lost you guys? Can you guys hear me?
Yes, we can hear you, sir.
Where did I lost you? On the gross margin explanation or the profit margin explanation? On the profit margin, remember the profit margin is going to show you for every dollar of sales, how much transferred directly to you, if you want, in your pocket. Because from the profit margin, net income is going to transfer to retained earnings, and then you can draw the dividend. Can you hear me, guys? Can you guys hear me?
Yes.
Okay, great. Always check for every dollar of sales, how much transfer to either gross margin, either to profit margin. That's with the gross margin and profit margin profitability ratio. Let's see this company. So their gross margin is 20%, start with 20% 2019, went to 21. First 22, then drop a little bit low to 21. Is this improving or getting worse?
Improving.
Improving, definitely. How about the profitability? We already saw that one from the statements. The first year was high, second year went down, the third year went up again. What's going to happen the next year? We have to see. If they follow the same pattern, 1 year up, 1 year down, next year we have to be down. But is that going to happen? We don't know. We have to see. Profitability ratio. Let's go with the return on equity. Return on equity, it's going to be net income divided by the average total shareholders' equity. How are we going to get the average total shareholders' equity? Beginning balance plus ending balance divided by 2. Return on assets, again, we're going to play with the net income divided by average total assets. So how are we going to get the average total assets? Beginning balance plus ending balance divided by 2. Let's see how this company is doing. Return on equity, from 40% return on equity, now they're 9.6. If you're an investor in this company, are you going to be happy?
No, looks like it's going down.
It's going down. Definitely going down. It went down with 5%. How about the profitability? Return on assets.
Still went down.
Still going down.
Yeah.
Okay, so then we're going to the one interesting ratio, which is earnings per share. We have two types of earnings per share. One is the basic earnings per share, and the other one is the diluted earnings per share. The basic earnings per share is the net income of the company minus the dividend that we have to pay to the preferred shareholders. The shareholders have preferred shares, divided by the weighted average number of common shares outstanding. That number is a little bit tricky to calculate, but we're not going to spend time for this. But that's how you get in the basic earning per shares. Diluting earning per share is usually a number which is lower than basic earning per shares. Why? Because we're going to increase the number of the weighted average common shares outstanding. Means that we're going to get all the possible options and all the possible conversion rates, and we pretend that those are actually exercised. And we're going to see if everything is exercised and converted to common shares, what's going to happen with the earnings per share. We're going to create some scenario which it doesn't happen yet, but what if this happens? What's going to happen with the basic earnings per shares? So here, this company earnings basic earning per shares was 146 in 2020, 153 in 2021. Obviously, earning per shares getting higher. Dilutive earning per shares, it's a little bit lower, as I said, usually. Why? Because again, we're increasing the number of the shares. For that reason, dilutive earning per shares always goes down. Next ratio is equity analysis ratio for the equity. That will be the price earnings ratio. Now, for the price earnings ratio, we have to check what's the current market price per share. And then whatever we're calculating per earnings per share, that will be our denominator. And then we're going to see what's the expectations based on the market price per share versus the actual earnings per share. So the company price per shares on the stock market with the company earnings per share, that's what we're chasing. Let's see how this company performed. The market price of the shares in the beginning was higher, then start going down. But earnings per shares also goes down. So the market, as you can see, once the investors see that the earnings per shares goes down, the market price start changing. Make sense? Can you see it?
Yes.
Yes, sir.
Investors are very sensitive. As soon as they see reduction in the earnings per share, they start selling the shares. When they start selling the shares, the market price goes down. After that, they saw increase in the earnings per share, so the market price recover a little bit, as you can see. The next ratio is dividend paid out. Means that how much dividend every single shares gonna get. So that's how we're gonna get it. Dividend per share divided by earnings per share. So in this case, the company from 34% went to 45.8%. Now, in this case, the dividend payout is actually improving. And the dividends note, on the dividend notes, we can see that what's happened with the dividends, that excerpt from these financial statements. The company implemented dividend reinvestment plan, which became effective as a dividend plan on July 20. That dividend reinvestment plan provides eligible shareholders with the opportunity to have all or portion of their cash dividend automatically reinvested into additional common shares. And this is one of the dividend policy that they implemented. Equity, the other one is the dividend yield. Dividend yield is the dividend per share divided by the price per share. That measures what the dividend an investor will receive relative to the price per share. So if the new investor is gonna come, he has to pay the market price. As we saw from here, the market price was 37. But he's gonna get a dividend 153. So how much is that in terms of the dividend yield? So what you can see here, the dividend per share is now 70 cents, 66 cents per share versus market price 45. And then we're going to have 70 cents versus 37.79. That's 1.85% is dividend yield. For the every dollar that you're investing, how much you're going to get as a dividend. Net free cash flow is the cash flow from operating activities minus the capital expenditures minus the dividends on the preferred shares. This company doesn't have a dividend preferred share, so that number will be 0. The only thing that they have is the capital expenditures. When you get the cash flow from operating activities and deduct the capital expenditures, you're gonna see the net free cash flow. How much cash you have available for any other operating activities. Now, everything that has positive has negative. Which is the negative in terms of the limitations? Let's think about the ratios in terms of limitation. Which would be the limitation of the ratio? Well, accounting policy is the first one. You have to know very well and you have to understand very well what kind of policy the company is using for different events, how they apply those policies, who is the accountant, who is the controller, how they interpret this policy. Then you have to go with the limitations, the definition of the ratios. The next one is all the diversity of the operations. You have to think, is this a seasonal business or not? And the other one is what's the chances there'll be manipulations in the preparation of financial statements? What we're gonna do with if you use the non-international financial reporting standards measures, which will be that? The example of those financial measures are the free cash flow, earning before interest, taxes, depreciation, amortization, net debt, debt to equity, net debt as a percentage of the total capitalization, or again, you can translate to total assets, interest coverage, and net free cash flow. Once you're doing those, you have to be cautious. Every time when you do financial statement analysis, be cautious and please understand, analyze, and interpret the numbers proper way. Because if you get the numbers, but you interpret it in the wrong way, you're gonna make the wrong choices. And that's complete this chapter. It's an interesting chapter.